Now, I mentioned Rule 21 on page 113, and that is, when can you buy new highs and sell new lows? And the time to do it is really in the late afternoon, because on the late afternoon you can buy new highs and make money because it's going higher yet, and you can sell new lows and make money because it's going even lower into the close. It's often the real thing, and it runs contrary to the numerous reversals and stop running that often characterizes the market earlier in the day. So what was a good fade in the morning is not a good fade in the afternoon. This is what I mean about that flexibility you need to trade. You have to be able to say, in the morning I'm willing to sell into rallies and buy into breaks because it'll probably all come back to the middle like I mentioned. But when you get into the late afternoon and the market wants to go somewhere, and especially when your confirming indicators are all pointing in one direction, then you have to go in that direction regardless of where you buy it. And I know what you're thinking is. You're thinking, it's at the highs. Why would I want to buy it now when I could have bought it 5 minutes ago or 10 minutes ago when it was at the lows? Well, then you didn't know it was going up. And so it's a better buy now. In fact, what this has to do with is probabilities. And my LSS system tries to do this, and a lot of people misunderstand what we're trying to do. They think we're trying to predict highs and lows and things like that, but we're really not. All we're saying is this, that the probabilities favor it going from price A to price B at certain levels. They say, well, why would you want to buy it way up there or sell it way down there? The reason is the probabilities are something like 90% that that move will continue if it gets there. Now, it's unlikely it'll get there, but if it does get there, the probabilities are very high. Second, remember the whole notion of the paradoxical event. The higher it goes, the more bullish it gets. The lower it goes, the more bearish it gets. In other words, there's certain markets where you can just keep buying the highs all day long, and if you hold it to the close, you'll make money. And the reverse is true of the lows if it's breaking. And it's important to know the difference between a market that's just going up and down and a market that's serious about going somewhere. So the time to buy highs and sell lows is late in the day. But again, you can't do it just any time. It's got to be the right kind of market. You got to have the right confirming indicators. The late afternoon trend's often the real thing, contrary to the numerous reversals and stop running that characterizes it early in the day. So you don't want to fade it typically late in the afternoon, not on a trend day certainly. And on 114 I have an illustration of that. Don't fade the final hour trend. This can be really fatal to the guy who persists in doing this. I've seen people sell into rallies late in the day thinking, you know, it hasn't gone up this far all day, now's a good time to sell it. Wrong. I buy new highs all the time late in the day, and very often it works out, especially if I'm having a good day and I'm a little looser about the trade. I'm willing to put in if I've made it on 6 or 8, I'm willing to put in a 2-lot buying the highs on the idea that it will go higher. And that also leads me to the whole notion of wins and losses in the market. They tend to be, in my opinion, cyclical, which means you'll have cycles where you'll win consistently, and then you'll have cycles where no matter what you do, you lose. What you have to do is tend to cut back when you're losing and ride it out. And I have another little trick I use when I'm on a hot streak versus a losing streak is, because I know wins and losses are cyclical, if I have a good run and I'm winning and winning and winning and winning, I may stop for a few days to short circuit what I perceive to be the inevitable losing cycle that is coming. And then I'll start over again with all the profits I made on the winning cycle, hopefully on a winning cycle again. And it doesn't always work that nicely, but it's worked lately. It's worked very well for me, that precise scenario. You win and win and win, and then you say, you know, this is getting too good to be true. I'm going to step back for a day or so, come back in, and then you start winning again, which is nice. And it also, you know, confirms that I'm doing the right thing. And again, I'm not thinking about the money. I don't try to make the same amount of money every day, because some days there's great opportunities and other days you're lucky if you can make anything. So you have to be able to take what the market gives you and adjust to the type of day you're having. But sound discipline and good trading rules will keep you on the right side there. On 115, I'm talking about a late afternoon trend. It's a one-way trip up. Here's an illustration where you can just buy highs and it's screaming higher. But look what happens overnight on 115 if you hold it overnight. And this, by the way, is why I'm a day trader, and I don't ever hold it overnight, win or lose. What will happen is they'll run the stops overnight, even if it's going higher the next day. In this case, it looked like it didn't. But even if it is, they'll run it lower and then take it up, getting the overnight stops. And again, the stop is no protection at that point, because if you had a stop even one tick under the low of the last bar here, up in the 73-something area, it opened down below 69. So that's the price you're going to get. You're not going to get the 73. You're going to be selling at 69. So you just gave up 400 points by going overnight. So, of course, that's one of my other rules that I never violate. Now, we haven't mentioned the confirming indicators, but Rule 22 addresses that. And I find that the more I trade, the fewer indicators I look at. And when I'm in a trade, I rarely look at all of them at the same time. Sometimes I go from one page to another. But I've got 4 charts on one of my screens. That's the premium, the cash, the Dow, and the tick. And I have them in bar charts, line charts. And I look for a divergence in those. And very often they really help in picking tops and bottoms, especially the premium. The premium is a very important indicator if you trade the S&P or any of the stock indexes. Because what will happen is, well, first let me begin with the definition of the premium. The definition is the difference between the futures and the cash price. So if cash prices are steady and futures prices are rising, what must happen to the premium? It must go up. If cash prices are stationary and futures are declining, what must happen to the premium? It must go down. What you'll get when the market makes a key top or bottom is you'll get a divergence between the premium and everything else. The cash, the futures, the Dow, the tick, the ticky. They'll all be at new high ground, say, and the premium will start to plunge. That means the party's over, it's going down, almost always, and vice versa at the bottom. You'll see everything on the lows of the day, and the premium will scream higher. The reason is the futures traders are in there buying the futures, pushing it up in terms of the cash, and that causes the premium to rise quickly. And that's a key reversal. And I write here on page 116, the premium in particular offers a powerful clue that market sentiment has changed, often moments before the market surges in the opposite direction. Not to see these reversals in the making mean you will have to join the crowd in exiting and often receiving a bad fill. And I can't tell you how important it is to get out before everybody knows. And you'll give up so many points when you're even a moment too late on this type of thing. So if I get a good run, well, first of all, if it gets to my price in terms of time and price, I'm out of there. If it gets to the time very often, I'm out of there. Selling into rallies, buying into breaks when I have the position on. If you overstay the market and you're late and the premium's already gone the other way, it's really, I don't want to say too late, but you've given back a big portion of your profits because there's now all panic going that way. When you stand in the trading pit, which most people haven't done, when you get one of these panics, there are no sellers if it's a buying panic. And there are no buyers if it's a selling panic. Every person in the pit wants to sell it or buy it. Only one thing can happen. The market's going to scream higher, it's going to scream lower. And eventually, a buyer or the sellers will be drawn out to take the other side, but not in the initial going when you get these moves. A week or so ago, I was trading I was short 6, and I went to cover on take a good profit, a few hundred points, and the brokerage house didn't pick up the phone, and I knew it was over because everybody was calling in at the same time to get out to buy it because there was a huge reversal taking place. And that's what happened. And I got caught in that as a result. The very next day we had the same situation, but this time instead of being short when it made a bottom, and it started to go up, and I was long, and the time it took them to answer the phone gave me another 300 points. I was willing to settle for a lot less, but there was panic buying, and then I wanted to sell it, so I was able to capitalize on that. So it's important to see these hidden indicators. It's what one trader has called the smoke coming under the door. You don't want to wait to know that the house is on fire. You see the smoke, you got to run or get out or get into the right side. Now, on 118, what I've done is put several indicators on the same page. I've got futures, premium, and cash. And what you'll see is how they all interact with one another. First of all, looking at the futures prices at the top part, the top chart on the page on 118, you've got a 10-minute rally which creates the first leg. You've got an equilibrium, and then you've got a second rally with a target sell. So in other words, you got the perfect time and price trade. You got rally, consolidation, rally, and then it does what it's supposed to in both time and price, and it stops momentarily at least. Up at the top, you've got confirmation. Look down to the premium now, and you'll see that shortly after it made that top, where if you're trading properly time and price, you would have gotten out, you have a sharp break in the premium all of a sudden. But look at the cash. The cash is still rising. The cash is going to new high ground. And the futures have just made a high. The premium has made a high and is already headed down, but the cash is still going up. And what happens? The market starts to go down there. And as you can see, it sells off there, at least momentarily, before going higher. But it's really that break in the premium confirms that top. And go over to 119, and you see the same thing. Rising futures, and all of a sudden, even though futures are going up and cash is going up, you've got a downtrend in the premium. And this is an important point. What you want to do is track the direction of the premium. In other words, are the highs on the premium progressively lower, or are the lows progressively higher? Here we have the highs progressively lower in the premium. This is telling me that people are not willing to buy it up there, but rather sell it every time it gets high, and it's going lower and lower and lower. There's some serious selling coming into this market. Look at the time of day at the bottom. We're going into the close. And there's been a lot of, even though the futures are going up, even though the cash is going up, somebody's selling this market. And the reason we know is because the premium is going down. Next page, 120, look what happens. The market opens a good 600 points lower the next day, 600-point break on the open, even though we had rising cash into the close and rising futures. Somebody knew about this move. They knew what was going to happen the next day. For whatever reason, and I can't tell you the reason, but for whatever reason, they had an opinion that all this sideways action at the end was sophisticated selling to unsophisticated buying, and the sellers won out because it broke hard the next day.